Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. At least that's what I was last time I checked. Today's Tuesday. It's October 11th. The market's going to be opening up in about an hour and 27 minutes, and we're down a bit, not really too much in light of the volatility we've been seeing. But this is a perfect example of a market that actually closed okay and is being derailed by global economy again. And that's been a trend we have been seeing. So let me get into global economy, and then I'll dwindle down to the nitty gritty. And by the way, folks, I really appreciate the feedback. I appreciate you liking, subscribing to these videos, and please post comments below these videos. I will respond and I will answer any question you may have. Now let's get into the video today. And I know the usual suspects have been supporting these videos, so I really appreciate it. So, technology sector is waiting on global benchmarks. Now, here's what I'm talking about, how the U.S. stock market closes okay, and then you have global news overnight that pushes us lower in the night session and causes us to open up or open down 150, 200, 300, 400 points. And that's been kind of the hallmark or the type of pattern we've been seeing the last 3 weeks now. And typically before June, the U.S. market was causing us to go down in the mornings. It was bad news here, but now it's global economy, and that's usually how it winds down before the good stuff begins again. But again, we're not done just yet. Taiwan dropped 4.4% after reopening from holidays in their first trading session since the U.S. imposed new limits on export of semiconductors and chip equipment to China. I mean, we really need that like we need, what right now? The world's biggest chip maker plunged 8.3%. That's substantial, especially right now in light of where we're at. In a bit of encouraging news, we can sure use some encouraging news. Japan reopened to generally unrestricted tourism on Tuesday. Yay! After more than 2 years of restrictions. Japan is just now getting rid of these restrictions. It's crazy how COVID changed the world. Pent-up travel spending could help lift the world's third largest economy as it grapples with slowing global growth and inflation. Do you think a lot of people are going to be flying to Japan from the U.S. or Europe with the energy prices the way they are right now? I mean, it's not a good time for travel. Technology stocks have taken a hit from the announcement of tighter export controls on semiconductors and chip manufacturing equipment. The restrictions aims to limit Chinese ability to get advanced computer chips, develop and maintain supercomputers, and make advanced semiconductors. Remember, the war is not with machine guns anymore. It's a technology war. And if Taiwan can get more advanced on semiconductors than China, that's a huge attractive and very valuable asset to have. Wall Street has been rolling by worries over stubbornly hot inflation and the Federal Reserve plan to tame high prices by raising rates, and we all know that. The goal is to slow economic growth and cool both borrowing and spending. Yeah, let's see how it works out for you at this point. The Fed is on a trajectory to destroy this economy, to get inflation under control, but risk sending us into a recession, and that risk gets higher every day. Investors will get more detailed pictures of the Fed's thinking on Wednesday and Thursday when the central bank's releases minutes from the policy meeting. And that's when the Fed made extra big interest rate increases of 0.75 percentage points. And I think they're going to keep doing it. Closely watched report on consumer prices will be released on Thursday, and a report on retail sales due on Friday. This week, corporate earnings. Now, speaking of earnings, as I mentioned, the top line is down from 9.8% to 2.6%, and I'll give you an update today in my VIP room if you're a member of my VIP room. Thursday, which is day after tomorrow, we've got these little fund stocks: Delta, BlackRock, which is a huge investment company, Progressive, Taiwan Semiconductors, and Walgreens. Very broad, and then we'll get into bank stocks. And I'll report. I talked about this yesterday, and I'll talk about it more as we get closer to it. But I have all of this for you, and we'll get into it. Now, the data that I'm talking about that I just brought up in my report, this is the FOMC minutes. It's actually not nearly as important as the PPI that's coming out tomorrow. The PPI, Producers Price Index, is the last Producers Price Index before we have our next interest rate hike. And the CPI is also the last CPI. And this is the biggest report by far. After these two reports, this retail sales report is going to have very, very little weight. unless it solidifies or completely contradicts the CPI. The number that's expecting tomorrow, and again, we're looking for a year over year, not month over month. We're looking for this number to be lower than 8.7. Anything below 8.7, 8.4 is welcome. And ex food and energy, we're looking for the number to be below 5.6. That's if that number is lower, then it gives us hope for at least a day till we get the CPI that inflation has peaked. And then for the CPI, again, we're only looking for year over year, and I'll show you what the Fed is looking at. You see this 6.3 right here? They're looking for this number to be 6.2, 6.1, and they're expecting it to be higher. So if this number comes in lower, it's a very, 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 very good sign that inflation has peaked. The CPI is expected to come out lower, and I'm really hoping that it will, because if this number doesn't come out lower, I don't think ex food and energy is going to be much different. So I'm hoping, but both of these numbers this is below 8.3 and this is below 6.3. Very, 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 very significant. Now, moving on, the put to call ratio is still within our window, so we're still above 1. And from where I'm sitting, we really do need to come off of these levels. Notice we've been above the 90 level for quite some time, which is telling us that market is really, really extended. And you could tell by looking at the number of stocks trading above the 100-day, 200-day moving average in the Nasdaq 100. We are literally, this is 2008. This is where we're at. This is COVID. We're way below those levels. And when you're looking at it on a broad, I mean, look at it. Everything is below 50. Everything is below 50. And most of the 50-day and the 200-day are in line with each other. Matter of fact, if you look at the NASDAQ, 14%, 9%, 6%, 6%. I mean, look at this. I want to show you how this looks. Dow looks. It's crazy. Look at this. This is 20 years of data, right? Or not really. It's like 16 years of data. But look at this. Look at where we're at right now. I mean, we are at the bottom. So I don't think it's a really great time to start selling off stocks, selling off blue chip stocks, or even selling speculative stocks, because speculative stocks are in fact holding up pretty well. Now, the big concern I have now is whether we're going to break this level or not. Keep an eye on it, because I think if we can stay above this level or stay at this level and not break it, we'll be in good shape. As you could see here, let me show you the Russell 2000. The Russell 2000 is holding on. It's holding on, folks. Look at this. It's holding on. Let's see. Let me see if QQQ is holding on. I don't know if QQQ is holding on, but that's significant. It's not holding on. Again, some sectors. Let's see if SPY is holding on. I don't think so. I think it broke. Yeah, it is holding on. All right. So if SPY can hold on, and if the IWM can hold on, and if ARK can hold on this week, there's a really, really, really good chance this will bottom. This right here, folks, this is small caps. This is the U.S. stock market bottoming out. This is a wait and see mode, and this is the global economy bottoming out. Again, if we can get past this global economy and earnings can start turning positive, we will get out of this in good shape. The fact that put to call ratio is still inflated, the fact that where are we here? The fact that the number of stocks, let me just go back here. The fact that momentum levels are like this is just crazy. It's telling us that we are very, very, very close to bottoming out. Now, it doesn't mean we can't stay here for a while, but we are very close to bottoming out. Now, look at the number of stocks making 20-day breakdowns. It's only 200. It's not 500. It's not 600. So there's not massive momentum to the downside. Yes, you have a lot more stocks going down than going up. You have 18 stocks making 20-day breakouts and 200 making breakdowns. But that's about a third of typical momentum levels to the downside. So I think if we can stay here, this will be a washout and we'll start going higher. My point here is the current downside momentum is not that strong. It may seem strong because we've been going down a lot, but it really isn't. As far as sectors are concerned, the strongest sector is energy, healthcare, consumer staples. The weakest one is real estate, which I'm finding very interesting. So if we were to go to our actual stocks, let's go to our actual stocks. So Twitter, strongest stock, Lamb Weston. If you want energy, The strongest energy stock right now would be MPC, Marathon Petroleum. Now, ConocoPhillips, Hess, Devon, U.S. Marathon, you can't really go wrong with any of these. But in my opinion, I would go with the healthcare right now. Healthcare has less global exposure. I like Cardinal Health, but I do also like energy stocks, and Marathon is great, and it's not expensive either. Great stock, no issues there. But I also like Lamb Weston. I like Cardinal Health. Notice healthcare is starting to come up here, as I predicted it would. So I would maybe diversify, put 50% in Marathon Petroleum and 50% in Cardinal Health, because healthcare and energy is what you want to be long right now. Now, to the short side, very, very interesting. Realty Trust, Vornado Realty Trust. Remember, real estate is the weakest sector, but same thing with communication. They've both been really knocked down. So what I would do is I would hedge myself. I would put 50% exposure in Dish to the short side and 50% in Vornado Realty Trust, or 50% in Charter and 50% in Trust. That way you have a little of both. Here's Digital Realty Trust, another one. These real estate trusts are bottoming out, I believe, right now. They're very, very low, but still, it's the weakest sector. We got to respect our momentum studies. So don't put all your eggs in one basket. I would go with Dish, Charter, Vornado Real Estate Trust, Digital Realty Trust. I would maybe even put 25% in each of those, because I don't like Dish, I don't like Charter, I don't like this Vornado Realty Trust, and I kind of like Digital Realty Trust. They have a really good business model. It's just right now, with potential recession, things aren't looking as great. We're going to get more trading range as the week goes on. Remember, today's really like the first day of the week. Yesterday we had the Indigenous People Day. I give up. Columbus Day, I tell you. Anyways, Indigenous People Day. They're going to make these more and more. I mean, little kids have to learn these words. Indigenous People Day. Wasn't Columbus Day easier to say? I don't know. The whole world is going wacky. But anyways, today's more like a Monday. So let the market heat up today, show its direction. Usually when we have week days coming into Tuesday, we have a turnaround Tuesday. I'm hoping that the news is going to be better than expected and the market rallies. The end of this week will really give us a good understanding of where we stand. I'm not happy with the bond market. The bond market has been going down. It has, in fact, been breaking lower, and I'm not happy about that. Now, interestingly, the short-term bond has really gone off the rails, and the yield is now, 4.3, 4.5 on the 2-year? We're getting up there. When the 2-year stops going up, when the yield on the 2-year stops going up, that's going to be the end of this run. But we're not there yet. Keep an eye on the CPI, the PPI, and remember, earnings start coming out on Thursday and last time earnings got us through this because they were so undervalued. But again, the yield on the 2-year has to start coming down. Now, folks, before I let you go, and we covered a lot of ground today, if you're like most investors, you've probably had a tough year in the market. And I get it. This roller coaster of volatility has been really hard to take, which is why I've been researching a way to simplify investing to slow it down. And what I've uncovered were 5 stocks that have never lost during the market crash, not since the year 2000. That's pretty significant. I truly believe they're positioned for another strong run for years to come, especially where we're at right now. We're bottoming. These stocks are part of what I call the ultimate portfolio. And I'm going to be holding a special webinar with trader extraordinaire Jack Carter today, Tuesday, October 11th at 1 p.m. Eastern Time. I'm going to be revealing these 5 stocks that Jack will be sharing his technique that make the ultimate portfolio that much better. This is red meat, folks. You're going to get a lot of value, and you're going to see something that's working right now. I'm actually considering applying this to my personal portfolio because it makes so much darn sense. It gives you an opportunity to buy stocks below fair value, get instant income, have your cake and eat it too. We should call this the have your cake and eat it too ultimate portfolio. But again, I'll be revealing 5 stocks, and Jack will be sharing his technique that makes the ultimate portfolio so much better. It doesn't cost a thing to attend. Click the link below, get all the details, follow these videos, subscribe to this channel, comment below this video. I will respond to you personally. No joke, I will. Have a great day. And remember, today's Tuesday, but it's much more like Monday because yesterday we had a federal holiday and banks and bonds were closed, and bonds is what drives stocks. So again, we only had international data to base today's trading action on. I've said enough. I'll talk to you later. Follow the link below. Jack is red hot. You need this right now. Bye.